Good afternoon. Welcome to this video in which we're going to look at various types of fraudulent schemes in which employees misappropriate assets. In some cases, they're outright stealing of assets. In some cases, they're just abuse of assets. But in either case, it's the employer that is denied the use of their asset, the access of their asset. So let's take a look at some of the schemes and what an employer can do to prevent this from happening. So the major categories of fraud are asset misappropriation, corruption and abuse. This is when the assets themselves are directly not stolen, but the company's name and reputation is at stake by making use of some of the advantages an individual has because of being affiliated with or having access to something within the company. There's financial statement fraud now, and other types of frauds, of course. These other topics, three topics, will be discussed in subsequent chapters. So when we talk about asset misappropriation, we are looking at skimming and larceny. These are the two major categories of fraud that we will be looking at. We will see what they are and what a company can do again to prevent that from happening. Okay, so with skimming and larceny, what we're concerned with is first the technical definition and then how it happens. So the skimming is the stealing of the asset happens before it enters the books. So before you have actually done a journal entry, before it's recorded anywhere, the asset is already gone. Larceny, after it has entered the books, it's stolen. So these are two different ways in which it is stolen. It's really a timing difference. But the method of stealing, the method of cover-up used by employees is going to be different. So let's take a look at skimming schemes first. So here we have theft of cash from a victim entity prior to it entering the accounting system. We call it the off-book fraud. And because it is not in the accounting system, it is really hard to find where it's happened because there's no audit trail. If it was in the system, we could backtrack it. We could have some way of checking what happened to the money. It can occur at any point where cash enters a business. So whenever cash comes into the business, it could happen. And we're going to look at some of the most common ways in which it would happen. Now recall, cash enters the business when, think of the statement of cash flow. Cash enters a business in operating activities when there's a cash sale or a collection on a credit sale. That's the most common way in which cash is coming into the business. If you're looking at investing activities, cash comes in when assets are sold. When you're looking at finance activity, cash comes in when cash is borrowed or investors put into the money into the business. Our focus is on those sales transaction, the cash sales, and the collection of credit sales. So here we are going to look at the sales and the receivables, as I just mentioned. So what happens in a sales transaction? If it's at the point of sale, it's fairly simple. A customer gives money, the employee collects the money, and then delivers the goods or services. Seems rather innocent when we talk about it as a single transaction. We have one customer that gave cash to one employee. The employee gave the goods and services. In this case, we're talking of a fast food restaurant giving the meal to the customer. Fairly straightforward. Now let's magnify this for a company. We're looking at many customers giving lots of money through numerous transactions, not just to one employee, but now to many employees. All these employees now, in each of these individual transactions, has to deliver the goods or services. Again, we're talking about delivering food to all these customers. So there's a lot of potential for lots and lots of things to go wrong over here. And we'll see what they are and how companies try to combat the situation. So continuing with the sales skimming, it's the most basic type of skimming. When the customer makes a payment, there is no record of the transaction. The employee collects the payment, delivers the goods to the customer, and never records the transaction. So effectively what has happened, the customer has given up their inventory, but never received cash. Cash has been stolen from them. So they have lost their inventory by way of not receiving cash. There could be a cash register manipulation. Someone may manipulate the cash register. They could have after-hour sales. Let's say for your business opens at 10 a.m. and closes at 8 p.m. After the business closes, an employee has 3 sales transactions. It's never entered in the books, and those things are gone off the books. You're looking at transactions only through 8 p.m. because that's when it closes. Another is off-site employees. You have employees who are working at another location. You're basically relying on their good faith that they're going to report all the sales that happen in that off-site location. Faith is good, trusting employees is good, but you want to verify. And from what we will be looking at in this semester, you want to have as many internal controls in place to make sure that, first of all, it never happens. And if it does happen, I have a way of catching my employee who is stealing. Obviously, if I have poor collection procedures, I'm going to be losing a lot of money. There could be an employee who understates sales. So the sales transaction takes place, the customer gives cash to the employee, the employee registers the transaction, but for a smaller amount, not the full amount, gives the inventory, whatever has been purchased, the full amount, but the journal entry is done, the recording is done for a smaller amount. And another old trick in the book is, if there is cash that has been collected, put down that you have received checks. Checks are also considered cash, but if I put down a bad check, it's not cash. And I really do not have the right to take cash and put a check in over there, even if my check is good. That's stealing. It's still stealing. So employees can steal money from an employer in any of these ways. They're fairly simple in terms of how they could steal it. And an employer is vulnerable. A business is vulnerable and they need to take care of themselves. And there could also be theft in the mailroom. Again, we'll take a look at this a little closely later on. So what can I do to prevent this from happening? It's always good to prevent. Well, if it does happen, how do I detect that it's happening? So first of all, let's see if I can have some kind of oversight. If I'm a larger business and I can have supervisors, I can have management that is walking the floor, it automatically gives a sense of fear to most employees. They don't want to be caught, and therefore they're less likely to steal if there's management present. If I could have some kind of video surveillance, remember, as we had discussed earlier, you cannot do this without notifying your employees, your customers, that you have video surveillance. This is fairly common. Most businesses will tell you that, smile, you're on camera, basically to alert you that someone is checking what's going on over there on the floor. Something that always is very effective is you basically engage your customers and ask them to complain if they see something wrong. A lot of customers do get upset when they see stealing because they are paying for their goods and they don't like the idea that the money is being stolen by the employee, and they are likely to complain, especially if the service is poor or if something has happened. You're likely to get customer complaints. So always keep the door open for tips. Also, when you have multiple cash registers, it is always a good idea for every employee to log in and log out. That way we know who has been at which register and at what point of time. Activity logs for off-site personnel. We want to make sure that people who are at a different location, that they sign in and we have logs as to when they logged into our system. And now with technology, it's fairly easy to make sure that you can keep track of employees, knowing exactly where they are with GPS tracking, how much work they have done, which customers they have talked to. So there are ways in which we can have fairly detailed activity logs. Always, the less opportunity there is to steal, the better off you are going to be and the customer is going to be. Remember the fraud triangle. You don't want that opportunity. Don't give them the opportunity as far as possible. Now let's take a look at receivables. So now we're looking at a credit transaction where the sale transaction has taken place. That part has entered the books, but now the cash is coming in for the receivable. Before it can be entered, it's getting skimmed. Now slightly more difficult than sales skimming, where it was cash coming in. Now we are looking at cash coming in on a receivable. Receivable payments are not logged into the accounting system. So when the money is received, I'm not writing down the journal entry where it's going to say cash debit, accounts receivable credit. Now, how could I get away with this? Because the customer who has made the payment obviously is going to say, I made the payment. Why are you sending me a second invoice? Why are you asking me for money? So a common way in which employees try to defraud their employer of this money in a receivable skimming scam is they will do what's called lapping. Lapping is basically the first customer that makes a payment, you've stolen the money, you wait for the second customer to make payment, apply it to the first customer, then wait for the third customer to make the payment to apply it to the second customer, so on and so forth. So this gets a little more involved. But once again, that first check was stolen before it could be entered into the system. Forced balancing, basically saying, I'm just going to go ahead and do a journal entry to make sure that the accounts balance out, even though the cash is not there. There you'll have to cover your tracks a lot more if you do that. Well, the covering the tracks, at some point of time, there's going to be a bank reconciliation. The bank is going to send a statement and someone is going to be looking to see if the journal entry was there that the money was received. How come it's not there in the bank? So an employee could steal that bank statement and not let anyone see that bank statement. Or they could actually just write off a receivable. So the journal entry that you should have, which would be cash debit, accounts receivable credit, you've taken the cash, you took the check and cashed it yourself. So instead of doing cash debit, allowance for doubtful account debit, accounts receivable credit will take care of that problem. I take that off my books. Or I give a big discount to that customer to make sure that that customer didn't have to pay the money. So these are basically book entries to cover up the skimming that has happened. Debiting the wrong account, that's kind of similar to lapping, where you're basically trying to debit wrong accounts for various amounts of money that has been received from different customers. All of these are rather involved. Obviously, it's an inside job, as in someone who has access to the books can do this. The most desperate way in which you would cover up your tracks over here would be destroying or altering records of the transaction. This would be a little desperate in that something is gone, it's missing. And anytime records are altogether missing, it gets a little scary for employers, and they know something is amiss over there, especially the auditors would be concerned about it. So what could I do to prevent this from happening? Strong internal controls. This is going to be the repeated message in the semester. The better your internal controls, you will have your assets safeguarded, and if there is a problem, you'll be able to detect it. Now, if you're a large enough company and can afford it, separation of duties is always a very, very valuable internal control. Another suggestion that many the fraud examiners and auditors would have is rotate the jobs. Don't let one person be on the same job year after year, because if they have been on the same job, they have created a system where they can bypass any kind of checks and balances that may otherwise be in place. If there's an employee who is not taking vacation at all, I would be extremely concerned. They have something to hide. I don't think there's any employee who loves their job so much that they will never take a vacation that they have earned. So this is a good policy that companies have, where they force everyone to take a vacation and get someone else to come and do your job for 2 weeks. That way someone else can see if there's something glaringly amiss over there. Obviously, if someone is a very clever fraudster, they will make sure that when they go on vacation, no one can detect any of the things that go wrong over there. But it's one way in which you can probably catch someone who is doing something wrong. For certain journal entries that are non-routine, get someone else to do a write-off. Okay, so if it is, you are saying that the customer has not paid the money and you need to write it off, the person who routinely does the journal entries should not be the one doing the write-off. Someone else, typically a supervisor, should do the write-offs. When there are discounts being given, exceptions being made, the supervisor should be involved. This would be similar to in case of cash transactions at a retail store. If you go to a grocery store and you are in the process of checking out your items, and there's one item you decide you don't want to buy for whatever reason as a customer, you have the right to say, I don't want that item. It looks different to me right now, it's more expensive, whatever the case may be. In most retail businesses, the employee is not allowed to take that item off that transaction. They will call a supervisor, and the supervisor will come and void that one item and let them proceed. These are basically outstanding internal controls to make sure that an employee is not bringing up items, voiding a transaction. There could be all kinds of things that the employee could do if they had that privilege. So even when you're looking at accounts receivable, write-offs should be done by someone else, segregation of duties. Your audit staff should be trained properly to know how to look for certain weaknesses in your business. Remember, when you have auditors come in, they may not know all the nuances of your particular business. You know some of this, you're close to the business, but you want someone else to do the checking, which is why you have these auditors come in. Both your internal audit staff and external auditors should be trained well in what to look for in your business. And then there are so many automated tests we can now do with data analytics software. Use all of those to make sure that you can find if someone is cheating and stealing from you. Another way in which an analysis that is done is aging of your receivables to see, is there any pattern? Is there any receivable that's old? If it's a receivable is old and you have told the customer several times, why have they not responded to you? It could very well be that the employee who has stolen the cash has never sent a notice to that employee, to the customer. So the customer is not aware that their account is still outstanding. So if you look at the aging of receivables and you see a receivable that's very old, pick up the phone, call that customer and ask them what happened. And if they say they did send a check, ask them, was it cashed? Show me proof. And if they do, then you know you have to follow up and find out what happened to that check. Let's look at some of the cash larceny schemes. Now, cash larceny means after it has entered the books. So someone is intentionally taking away the cash against my will. I'm the employer. So money has already appeared in my books and then it was stolen. And where could it be stolen? Well, anywhere there's cash, it could be stolen. So it could happen at point of sale. It could happen from incoming receivables. It could happen from deposits, bank deposits, and we'll talk about that. So point of sale, some things we've already talked about over here, are a large percentage of cash larceny schemes occur at point of sale. And that's because that's where the money is. So where would I steal from? I'm not stealing from my own register. I'm the employee and I'm stealing from someone else's register. Maybe they asked me to cover them for a few minutes. Maybe I went there to do something, their back was turned. Any of those situations happen, especially when it is very busy. And in any of these cases, if someone is stealing, probably if you had management on the floor or you had video surveillance, you could catch them. Another common way in which employees will defraud an employer is what's called death by 1,000 cuts. That is, you're not stealing any one time, any large amount. You're stealing small sums of money. It could be like a couple dollars a day, but all of these add up to be significant amounts in the long run. And if there are multiple employees doing this, the employer is going to suffer losses very quickly. I've already discussed the reversing transactions, voiding a sales transaction, recording unauthorized discounts never given to customers. An example of this is at restaurants when a customer receives the check at the end of their meal and they're ready to leave. It's not uncommon where a customer will look at the receipt and say, look at the check and say, okay, I owe, let's say $25. And they leave, let's say $30 over there. $25 to pay their bill and $5 as a tip. They just leave it on the table and they walk away. The employee could take that receipt, go back and apply a discount saying they gave a coupon. And instead of $25, now it is only $20. Now the customer has paid $20 plus a $10 tip. It's actually $20, $5 was stolen from the employer and a $5 tip. The customer is none the wiser because they've already left the business. The employee has effectively stolen $5 by way of a discount. Unfortunately, this is not an uncommon problem at all at many restaurants. Altering cash counts or cash register tapes. Again, these are more involved in that someone is proactively saying, not only am I going to steal the cash, I'm going to try and cover up how I'm stealing the cash. And most desperate is destroying the register tapes. So how can we prevent this from happening? Again, strong internal controls. If you can have segregation of duties, anytime there is a discrepancy between sales record and cash on hand, you need to investigate immediately. So how does this happen? At retail businesses, you may have seen at the end of a shift, an employee, when they are leaving a register, they take their cash drawer with them and they go back to the supervisor. The supervisor is going to count the cash, check it against their sales record, and if there's any discrepancy, they have to explain it immediately. They're not given time to even leave their shift until this discrepancy is resolved. That is a really strong and effective internal control to have in place. This obviously assumes that you have supervisors who are there to count cash with, as there's a turnover of your the shift before the next employee comes, to have this on a going. If you do not have that, losing cash between shifts is a rampant problem. What else could we do? Reports on discounts, returns, adjustments, and other concealing transactions should be analyzed. Okay, so if there's one employee giving discounts, there's one employee who has more returns and adjustments than anyone else, either they have been very poorly trained, these employees are just not good employees, good workers, or they are stealing. So you need to find out immediately what's happening. So if you print out reports and do a daily analysis, you're likely to find the person who is doing this and put it to an end immediately. Larceny of receivables. This is stealing cash from incoming payments. They hide imbalances caused by frauds, forced balancing, reversing transactions, destroying records. These are all things we talked about. Let's talk about cash larceny from deposits. Now, this is from the time either it was a cash transaction and cash was collected, or it is receipts that are the receivables where payments have come in and I have checks. The cash and checks have to go to the bank. They have to be deposited in the bank. So it's from the time it has come into my books. This is larceny, which means it's entered the books. We have done the journal entry, cash debit, sales credit, or we've done the journal entry, cash debit, accounts receivable, credit in our books, but this cash has to now go to the bank. So what happens over here? So this is money is taken before it is deposited. It is difficult to conceal because it's already in the books. Most common way in which I can cover up is deposit lapping, or just say these are deposits in transit. All of these are easier said than done, but again, they're done. That's why it's being discussed over here. So how could I prevent this from happening? I have to take the cash from my business to the bank. Okay, is it possible for the bank to come to me? Well, the bank won't come to me, but I could do something different. I could have pay for armored truck service, where the armored truck comes and picks up the cash. So after we've done the journal entry, we have the cash in the safe. They're going to take it on a daily basis or a weekly basis and take it to the bank. Depending on the level of service I have and how much I pay for the service, they may count the cash at my business before taking it to the bank, or they may just take it to the bank and the bank counts the cash for me. Another option would be, I don't get into this business of cash. I encourage all my customers to use credit cards or debit cards. Obviously, there's a cost associated with it. However, that cost may be smaller than the cost of the cash larceny or cash skimming that could happen, and trying to uncover who did it, how it happened, etc. So the price may be small to pay. There's a cost to doing business, and this could just be one of the cost of doing business. After you have deposits made, get itemized deposit slips. So I just don't want to know that $10,000 was deposited today in my account. I want to know what that $10,000 consisted of. Was it checks? How many checks was it? Was the breakdown of the checks? Was it cash? How many $10 bills? How many $100 bills? I want all the breakdown so that it makes sense. Is this kind of what I was actually depositing or not? and then compare your deposit slip to that of the organization. The deposit slip that you received from your employee, I could turn in a Wells Fargo deposit slip saying, yep, $10,000 was deposited. These were all the checks that was deposited. Everything is correct. But did it go into the company's account or did it go into someone else's account? Those are things you need to watch for very closely. May sound a little strange, but yes, it does happen. Have the bank deliver 2 copies of the bank statement to different people in the organization. Why? Because recall previously we said a desperate thing that an employee may do is destroy that bank statement before bank reconciliation can be done. Now, if you have 2 statements coming in, then that person is not going to get away scot-free. These days, you could actually do this more effectively by way of looking up online transactions on a daily basis. So there are more ways in which we can handle this problem, but it's still always good to let employees know that the bank is going to send us 2 statements. So it's not just you, someone else in the organization is also getting a bank statement. Now let's shift gears and look at non-cash assets. Is it possible for it to be stolen? Absolutely, yes. What kind of non-cash assets can be stolen? Well, pretty much all of them. So we're looking at inventory, supplies, equipment, and any other non-cash asset that can be stolen, will be stolen. So how does this happen? Misuse. I come to school. What should I use my computer for over here? What should I use the phone for? Only school work. Is it possible I use it for something else, surfing the net, maybe going on to Amazon and doing some shopping, going and looking at vacations? Yeah, I could do that. That's misuse of assets. That was not the intended use. So we're looking at misuse of assets also as a fraudulent scheme. Unconcealed larceny. And we're going to get into each of these in a little detail as to how these happen. Larceny is stealing, unconcealed is they're not even bothering to cover up the stealing. Requisitioning and transferring, the purchasing and receiving, false shipments, many, many ways in which this happens. So let's look at misuse of assets over here. So misappropriation could be misuse or stealing. Unauthorized use of company assets with false statements. So I say I'm using my asset only for what I should be doing, but I'm using it for other purposes, especially if I profit from it. That is, I get outside income by being on that computer, by using that phone. That is definitely unauthorized use of a company asset. Use of office equipment to do personal work on company time. I'm billing the company for my time, I'm getting paid, and I'm using it to do some work of my own. Cost of inventory abuse, different types of inventory abuse we're going to look at. So let's look at some of the abuses, how they happen. The employee takes property from the company premises without attempting to conceal it in the books and records. So someone is stealing inventory, they're not even bothering to hide it. They're taking it quite open in plain sight. So how do they do this? Why would they do this? Well, obviously, they're doing this because they feel justified. They feel justified in that management gets all kinds of things. We are just workers. We don't have this privileges, and therefore I can take some of this inventory. No one is going to miss it. It's not going to hurt the company. All the usual arguments. There could be a fake sale. I basically say I purchased the asset, the inventory item, and I walk out with it. Think of someone working at a pizza place. Is it possible that they could buy a pizza? Yeah, they could buy a pizza at the end of the shift and take it home. Now, is it possible that they actually just took a pizza and said that they made that that it was a purchase transaction? They could do that too. So in some cases, the employee doesn't even bother to cover up what they're stealing. Now, I have a quick story. Stanley Black & Decker. This is a company that is a Fortune 500 company, and it's near and dear to us because it's right here in Towson. Black & Decker was over here, and they've merged with Stanley, which is out of Connecticut. So the founder's son, this was way back in the early 50s, he found that there were several employees that were stealing small assets from the contractors, defense contractors. They were big in defense business back in the 40s and 50s after World War II. And the CEO of the company said he thought it was very strange. On Friday evenings, all these little assets were disappearing. And then come Monday morning, all the assets were back on the floor. And then the employees were doing all the work that they were supposed to do. Again, Friday evening, all those assets were disappearing. So he talked to the foreman and went and talked to all the employees on a Monday morning and asked, what's happening to these assets? I came on the weekend, I didn't see it. And a lot of these employees said, oh, we just borrowed it because we had some work to do at home. And Decker Jr. decided that this was actually an opportunity, and he decided to flip the situation. And he is the one who started the entire DIY business that we know of today. He actually started saying that instead of being only in the industrial tool business, how about having small tools that we can sell to the general public? And he asked his employees, would you buy this if you could have bought this? And they all said yes. So what was a situation of unconcealed larceny turned out to be an opportunity for Black & Decker, and they have changed the face of how business is done and how all of us handle various things at home, small projects at home. We no longer have to call a contractor to do small projects. We can pick up the hammer, we can pick up the drill and do our own job. The point over here really is that this kind of larceny happens all the time. You may be a big company, you may be a small company. It happened in the past, it happens now, it's going to happen in the future. What can you do to control the situation or flip it to your advantage is a real key here. So let's see how I can prevent and detect larceny of non-cash assets. If I can have segregation of duties, who is requisitioning the items that are being purchased? That purchasing function, keep it separate from the requisitioning. So the person requesting that the company needs X, Y, and Z should not be the one placing the order for X, Y, and Z. And then the person who receives the X, Y, and Z should be a third party. Usually this is feasible in large companies. Small companies, it's not going to be feasible. The person who requisitions may probably be different from the purchaser who does the purchasing and the receiving. Purchasing and receiving in lots of places, the same person. It's not going to be segregated. But again, large companies, if they can, they should do this. Wherever possible, lock your assets. So in a lot of financial companies, as an example, it is very common for everyone to have laptops. In a lot of cases, what they would do is they have desktop computers and laptop computers. And the expectation is you bring your laptop computer to work, or it is stored at work and it is locked. Only when you go out off-site, you're going to be issued that laptop, so that it's constantly coming back to work, and they have some kind of monitoring. Sometimes it seems a little excessive, but remember, it's not just a laptop. What do financial companies need to worry about? They need to worry about data that you're carrying also. So they do have a lot of controls in place. Restrict access to only authorized personnel. Basically don't have anyone walking around anyway, because then you don't know who has stolen what. If you have security cameras in place, that helps a little too, but it's going to help only really after the fact. That is, after someone has stolen, something is lost, then you're going to look at your security cameras. Remember, try and inform employees that they're being videotaped all the time. Even if you do your perpetual inventory count all the time, it's always a good idea to do periodic inventory. That is, you just go walk on the floor and actually physically count your inventory. And anytime a customer is going to complain about something, keep an open ear. Have some way in which you can record these complaints, because that's typically your best bet of finding out that your employees are doing something wrong. Okay. Asset requisitions and transfers. Someone within the company is using an internal document to gain access to merchandise. Now, Is it possible that they need it? Absolutely. How's the business going to run if they don't requisition for various items, whether it's goods or services, whatever it is that we are in the business? I need to have my whatever I need, my tools of the trade in order to run the business. Now, is someone just using these documents to move assets from one location to another? Absolutely possible. Okay. Is it possible for someone to overstate what is needed and then pocket the excess? Yeah, unfortunately, yes, that's possible. Now, government agencies tend to have this problem, a lot of it. They tend to overstate what they need. And the reason they do that is because they are on a budget. They work on a budget system. They have to budget a year in advance they have to project what their needs are for the next year. And we all know whatever you ask for, you will get at least 10 or 20% less. So if I ask for 110 or 120%, well, maybe I'll get 90 to 100% of what I think I will need. Now that is if I was just doing things in the normal course of business. How about if I intended to defraud my employer? I can pad that budget and say I want more, and then keep that more, the excess, for myself. Falsify forms and remove non-cash assets from warehouse or stock rooms. Again, these are things that are done very frequently, and it's a matter of how often it is done and to what scale it is done, how the magnitude of the stealing that happens. Purchasing and receiving functions, how could they be used to facilitate theft? False billing, you purchase merchandise that the company doesn't need, and then you're billing the company, and the company is paying for it because all the paperwork is in place. The paperwork is in place, but you purchased merchandise that was not needed at all. Non-cash misappropriation, intentionally purchased but misappropriated by the fraudster. I'll give you another quick example over here. In recent years, a lot of businesses are moving to digital records, all digital records. So they don't need anything paper oriented. So I don't need to purchase as much paper as before. I don't need to purchase envelopes as much as before. Think of it, if I had to print an invoice and mail it to my customer, I needed paper, I needed the envelope, I needed ink, all of those things. I need to send them a reminder and a reminder. I need lots of paper, lots of envelopes, etc. Now everything is being done electronically. We don't need as much paper. But if I continue to purchase paper and envelopes, this is misappropriation. What am I doing with all this? And if you actually go and look at some agencies, such as some businesses, such as hospitals and a larger business where people are not paying very close attention to these items, there are people who are stealing this. They're taking it home and using it for personal purpose or trying to resell it on eBay and Amazon or wherever else. So the misappropriation is rampant, is there. Falsifying incoming shipments. Here the fraudster creates false shipping and sales documents to make it appear that the inventory was sold, not stolen. So here what they're saying is that a sale transaction happened and that the item was shipped, but it was never shipped. There was no sale. They just stole. So they're just inflating it and saying that there was a sale that happened over there. There's less likelihood of you getting caught because you're not stealing it here, because you're even having it shipped to your home, perhaps. They're even delivering these goods to you. So you understate the legitimate sale, so accomplice is billed for less. So what you're doing over here is you're saying that there is a sale that's happened and you're offsetting one sale for another sale. So again, this is done by people who are close to the business, as in close to the books. They have access to the books. So larceny, typically you're looking at someone who has access to the books because they can then cover up their fraudulent behavior. What are some of the other schemes? Employee tailor their thefts to the organization. What does it mean? They basically know, this is an inside job. I know where things are, how things move within the organization, who is looking at what, and accordingly, I design how I'm going to steal it. So I know the security system. I know how the records are kept. I know the building layout. I know all the day-to-day operations. So this is a complete inside job where I have planned the theft. It's not in the heat of the moment that I stole one item. This is something that an employee is doing because they know how they can steal from a company. Write off assets to make them available for theft. So this is another, in retail business, it's not uncommon where you would have an employee mark down an item and say that this item is heavily discounted, and then they purchase it themselves. In that case, they're still at least purchasing and it's recording as a transaction. If you write off an asset, you're saying this asset is worthless, and then they take it. Well, when they take it, yeah, they are stealing. Even though you have said that the asset is worthless, it's truly not worthless. It is. It could be actually sold at a profit, perhaps, by the company. But because you have made it worthless, the company is not going to make an effort to sell it. Some companies have a policy where if an asset is worthless, they will still give it away to a not-for-profit. They don't let the employees just take it. And in some cases, they will tell the employees, we will sell it to you at a discount. They will not just give it away. So employers can try to protect themselves, even in the case where employees try to manipulate the books. How do, if inventory is getting stolen, how do they cover it up? What's the concealing method over here? Unaccounted for reduction in inventory. Where did this inventory go? Okay, so if this is unaccounted for, which means there is no way to explain it. There is accounted for reduction in inventory. There is always shrinkage. We know about that. You learned it in cost accounting. We're talking about something that's unaccounted for. The question is, where did that inventory go? Is this a red flag? Did someone alter the inventory records? Do we have fictitious sales and accounts receivable in our books? Is someone stealing it that way? Did someone write off the inventory? Is there physical padding? Just like your accounts receivable padding, those deposit paddings we talk about, employees will even resort to physical padding, which means they could prop up 20 empty boxes and next to 5 boxes that actually have inventory. Those 20 empty boxes represent the stolen merchandise. So that if someone comes to count the pallets, count the boxes on the pallet, they'll say, oh yeah, there are 25 boxes over there, all is well. So what's one way in which you can make sure this doesn't happen? Actually open those boxes. Okay. There are, again, using technology to your advantage. Companies like EY, when they do physical count of inventory, they use drones to count the inventory. They have heat signature to find out, are those boxes empty? Is there something in that box? There are various ways in which you can use this to your advantage to find out what happened to the merchandise. Altered inventory records. Again, just like bank reconciliation, someone could try to force an inventory reconciliation. That is, my books say there are 500 units of inventory. I go and count the inventory, that is 450, 50 are missing, but I just write that there are 500 pieces of inventory. So first act of fraud was stealing. Now the second act is lying that there are those 50 are not stolen. So this is going to give the appearance that there is no shortage. We've talked about fictitious sales and accounts receivable, creating sales to mask the theft of accounts. You debit accounts receivable, you credit sales. What does it do? Now you have all these receivables in your book. Now, you could either just say that these receivables now are uncollectible and write them off to cover up. So now what you're looking at is there are layers and layers and layers of lies that are there when there is any kind of theft. Some employees, fraudulent fraudsters, will sell to large clients. Large clients are very, very large customers. The volume of transaction is very large. The dollar amount is very large that they will not notice a $5,000 or a $10,000. And in some really bizarre cases, well, they're not bizarre. It's basically the other company, your customer. They have very poor internal controls. As long as they receive a bill, they're going to pay that bill. They don't even bother to see whether they received the merchandise. And clearly, this is a case where you have stolen from your employer. Now you're passing that problem on to the client, and that client's accountant makes the payment. Now that accountant was not doing it, is not technically a fraud, but they have misappropriate funds. They have made a payment to a vendor from whom they never received merchandise. They have been defrauded now. Writing off receivables, again, is a common solution for fraudsters. Again, make sure that this function is decoupled. You don't want the same person doing both the collections and the write-off of receivables. Okay. I had a brief interruption over there. Hopefully this has not messed up my video too much. Let's continue over here with physical padding of inventory. Here, as I explained, a fraudster would make it appear that there are more assets than that are actually present over there. Setting up empty boxes, setting up a wall of products where nothing is behind the wall seems rather naive. Someone would be naive to believe that this could actually be happening, but obviously the fraudster knows when and how to do these kind of things. So how could you prevent this from happening? Separation of duties. Who orders the goods, who receives the goods, who maintains a perpetual inventory records, payments made, all of these need to be separate functions. Larger businesses can do it, but don't isolate them to the point where they become silos, where when someone receives a bill, just makes a payment without actually checking to see if those goods were received. If goods are received, check to see who requisitioned it. Does it make sense? Why these goods were ordered? Match invoices to receiving reports. Match packing slips to purchase orders to prevent fraud from happening over here. Monitor increase in bad debt expenses. So if you're writing off too many expenses, too many of these receivables, there's a pattern over here in terms of what you possibly is going on behind the scenes. Continuing on with this, reduction to perpetual inventory should be properly supported. Okay, so if you're doing perpetual inventory and there is shortages over there, is there any documentation explaining why there are these shortages? So if someone is doing a reconciliation to physical inventory and reducing the numbers, can you explain why that was done? Reconcile materials ordered for projects to actual work done. So if I had to paint 5 rooms and I purchased paint for 10 rooms, why was this done? So if there was paint purchased for 10 rooms, we need an explanation as to why there was double the quantity purchased. Maybe there's a good valid reason, but you need to find out what the case may be, what the reason is, okay? Periodically perform trend analysis on inventory. So just as you would do trend analysis on receivables, you want to do trend analysis on inventory, anything that's been designated as scrap. There we said if there was something, a receivable that was outstanding too long or had been written off. Here we are looking at anything that has been written off as scrap. Only remove assets with proper authority. So if an asset has to be discarded, only the person authorized to do that should be doing it, not just about anyone who feels like it, or I just decide I don't like this computer on my in my office on my desk and I'm just going to take it and place it somewhere else or just put it away or take it to my home. No, that's not to be done. I have to have proper authority to move it. Remember, skimming and larceny, it happens all the time. Why does it happen? Go back to the fraud triangle. Anytime there's perceived opportunity that I can steal, there's an employee that's going to say, why shouldn't I steal it? The rationalization is always there. Well, they're not going to notice if I take a little inventory. They're not going to notice if I do a little of my homework on their work computer. During work hours, I'll work later on. But if you're working later on, you're probably charging overtime to the company. Rationalization, you can rationalize just about anything. And if someone has financial pressure, they're likely to steal anything and everything. They're desperate. So any of these or any combination of these three prongs that you have over here is going to lead to skimming and larceny. You need to be aware of it. Don't be foolish thinking, not in my company. It doesn't happen over here. Think about it. What can you do to help your employer, your own business? What can you do to prevent this fraud from happening? So there's lots of room for us to think about what we can do to prevent it in the first place. And if it is happening, what can we do to stop it from happening?